A pension strategy that could backfire. Such a good article from a few years back from Kippinger's that another subscriber sent to me. And again, I forgot who sent this, but my appreciation. It's a wonderful article. I dealt with this a million times this Sunday, especially with military retirees with survivor benefit plans, SBP, and the life insurance salesman over at First Command and even USAA and other places. Just a lot of life insurance guys come from military backgrounds, and then they go talk to their fellow service personnel and to give them this pension maximization strategy. One I concerns me. So let's dive into this. Don't forget to subscribe. If you're military personnel and you have a pension, did you take the SBP, Survivor Benefit Pension, SBP? That's a big deal. Now, even if you're not a military personnel, even if you're just a regular employee with a pension and you have the Joint and Life Survivor Annuity, JLSA, that means you'll have a reduced amount of your pension in order to have your spouse get the 100% pension benefit. So let's just say your pension is $2,000 a month. It might be $1,800 a month with 100% survivor benefit. Does that make sense? $2,000 a month for your life only, $1,800 a month if it's for you and your spouse's life. So if you die, he or she gets the $1,800 a month still. So it's $1,800 a month while both of you all are alive, $1,800 a month if you die. And basically you're sacrificing $200 a month for that. And the SBP is a similar thing. I think it's $330 a month for the SBP for I think it's 30 years. Off the top of my head, I can't remember. But that's how it works. So you're basically saying if I take a survivor benefit pension, SBP, my surviving spouse will get 55% of my pension. So if I have a $2,000 a month pension, we'll just say she'll get $1,100 a month. All right, she'll get $1,100. So I'm going to pay, I don't know, what's it, 300? I think it's $330 a month for 30 years to guarantee that if I die, my spouse will receive $1,100 a month as a survivor benefit pension. Look, I get it. That's a tough one. That's tough because you're spending a lot of money on the SBP in order to give your surviving spouse not a huge pension. Whereas in a regular pension, it's $2,000 a month on you. You're a single individual life, or it's $1,800 a month on the joint and life survivor annuity. That's different. You're only losing $200 a month, and in that case, your spouse is still getting 90% of what you could have had on your own life. So it's a challenge. But with that said, it's not all peaches and cream. So let's look at this. This is good. Again, whoever sent this to me, mucho gracias. That's mucho gracias or Dankeschön. That's how we say it in German. Got my Bruins shirt on, by the way. Game 6 tonight in St. Louis. I'm predicting 5-1 Blues. Come on, man. Just give me a Game 7. We haven't had a 7-game Stanley Cup since the Bruins played Vancouver in 2011. All right, so anyway, pension strategy can backfire. Taking a life-only pension payout and buying life insurance to protect a spouse comes with risks. Yeah, I cannot agree more. Dateline, September 2013 from Susan Garland. It's an old article, but the facts still remain exactly as she states them here today. All right, so Susan writes, couples who qualify for an employer pension need to make a big decision before they retire. Should a retiree take a life-only annuity which provides the highest monthly payout but ends when the pensioner dies, or choose a joint and survivor benefit which offers a lower payout but one that continues after the retiree dies for as long as the spouse is alive? If the employee due the pension is likely to die first, the joint pension is usually the best route. But some insurance agents may try to steer you to take a strategy known as a pension maximization. It works like this. You take the higher payout, the life only on you, we'll just say the husband in this case, and use all or part of the extra income, the money that you're not paying towards the surviving, in this case, the SBP for military or the joint and life survivor annuity for the second to die, essentially, to buy a life insurance policy. If you die first, your pension ends, but your spouse will get a death benefit that will supposedly be enough to generate at least the same income she would have received as under the joint pension. If she died first, you cancel the insurance and continue to take the higher payout. However, the strategy may not work out as planned. It's essential to examine the numbers closely before you sign away your rights to a joint pension. And look, we're talking about the spouse here, by the way, not so much you, the pensioner. We're talking about the spouse. How are you going to leave him or her situated upon your demise? If the goal is to have a steady income through life, why jump through all these hoops, says Rebecca Davis, the legal director of the Pension Rights Center. I don't know. I mean, I don't agree with that assessment right there. Why jump through just because you jump through hoops doesn't make it bad. Mark Maurer of the Low Load Insurance Services in Tampa develops pension max strategy for clients of fee-only CFPs. He says that just 20% of the clients he reviews do better with the pension max than the joint pension option. Maurer offers an illustration of one plan he developed for a 61-year-old man and his 59-year-old wife. The pension offered a choice of a monthly $43.56 life-only payout or a 100% joint benefit, JLSA, Joint Life Survivor Annuity, which would pay $3,557 as long as one of the two spouses was alive. Under the pension max, the worker chooses the life-only benefit with an extra, we'll say, $800 a month. He uses $660 a month to pay premiums on 3 life insurance policies, a 10-year $200,000 term, a 20-year $200,000 term, and a $370,000 universal life policy. He qualifies for low rates because he is healthy. This won't work unless the client is a better than average healthy non-smoker. A big issue for the pension max plans, though, if the husband dies, will the death benefit be enough? You really want to see if the wife would be able to use the death benefit to buy a guaranteed fixed annuity that's greater than what you give the joint pension, says this guy from someplace. He says he's skeptical that these plans will work in the survivor's behavior. In Maurer's example, if the husband dies after 22 years, the 81-year-old wife would use a tax-free $370,000 to buy a fixed payout annuity. At today's rate, since 2013, the annuity would pay $3,388, which is lower, just a bit lower than the pension from immediateannuities.com. He's quoting that. But Moore notes that with a pension, payments would be fully taxable, and that the 15% would leave the widow with just $3,023 of after-tax spending. With the annuity, most of each payment would be tax-free, return of investment, so the widow would have more spendable cash. Yeah. All right. So, however, Vernon says the pension max plans are often based on assumptions that may not pan out. He has C plans that provide just a 20-year term life policy on a worker's life. If the husband lives longer, he'll have to buy term insurance in his 80s, and that will be phenomenally expensive. Some strategies use insurance with death benefits that grow based on market assumptions. If the market grows at a lower rate, the death benefit can be too low to cover the survivor's expenses. Also, pension max plans don't account for the taxes. In Maurer's example, the couple must pay tax on the $4,356 payout, squeezing the after-tax on cash to cover the insurance premium. Okay, so let's see what they missed a huge component of this. I'm actually surprised. I read it too, and I just recognize that now. So let's see some of the comments here. I want to see if anyone sees the problem with this first. So Christopher or Channing Hindell, this is why people have pensions should buy the life insurance in their 40s when it's okay, and whatever. What about the 22 years of extra income? Did you overlook that small detail? All right, so I don't get that. All right, what they're missing is when you buy the universal life policy, what happens if it doesn't survive? All right, and that's what I've seen. All right, so I've seen these guys who are first command. They sell these UL policies, which aren't funded heavily enough at all. And so what happens is as you get older and older and older, the interest rates stay low and low and low. The initial illustration that they use to make the pension maximization scheme seem like it's a guaranteed thing, it doesn't become guaranteed. And so what happens now, the guy's 81 years old, his life insurance, the 2 term policies are gone. And now his life insurance, his universal life insurance is on his deathbed simply because it doesn't have enough cash in there. Because the interest rates were so much lower than when first proposed. And that, I'm telling you, I've seen this happen a million times a Sunday. You're like, oh man, you're 82 years old. You didn't do the SBP. Now you're in a world of hurt, and we only have $10,000 left of cash value in your life insurance policy. So what do you do there? I'm telling you, man, I don't think it's a good strategy at all, because I just tell you, the issue here that we have is a lot of these life insurance policies do not pay out without certainly not to the extent that they were suggested when it was first illustrated, because it's based on a lot of times a higher interest payment that no longer exists today. I mean, look, your 10-year treasury is paying 2.1, my friends. Let me just see real quick. 2.1 on a 10-year treasury, 2.084. Anyway, the point about that is if you're only getting 2.084 on a 10-year treasury and you're getting 2.6 on 30-year government treasury, it's hard for these life insurance people in companies to make any money. So they're going to something's got to give. So you got to be very, very, very careful with buying life insurance to offset. If you die and your surviving spouse has no pension, be careful, because that life insurance, if it's not there, then she's in a world of hurt. All right. As always, don't forget to comment down below. Again, have you done a strategy like this? Are you pretty comfortable? I'd love to hear your comments on this, because I'm telling you, military personnel get this all the time, and it drives you crazy. All right, we'll see you next time.